Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Seeing you again on the new topic of Intermediate Accounting 2. We'll be discussing about dilutive securities and earnings per share. Basically, would describe the accounting treatment or approach for the issuance, conversion, and retirement of convertible securities. And specifically for the share warrants, maybe the term that is new for you, and the share warrants that are issued with other securities, accounting for reporting for share compensation plans, yeah. And you'll be also learning about calculation of basic earnings per share and diluted earnings per share. Yeah? I believe several terms are very new for you, but if you read through the topic, you will be understanding, inshallah. Okay, some instruments, some securities instruments are of hybrid in nature, yeah? Or mixed combination of liabilities and equity. They are not really liability, they are not really equity. Yeah? That's what we call as a dilutive securities. Dilute means reduce. Yeah? So certain debt options or the type debt instruments are having the possibility to be converted into equity later on. That's what we call as convertible securities. Yeah? And because they can be converted into equity, that means they would dilute the earning per share of the existing equity. That's why it is called as dilutive securities. Yeah? The same with share options. Yeah? Share options means certain instruments of securities can be converted into share. Yeah? And also preference share. Some preference shares are issued with the term that those preference shares can later on be converted into ordinary shares. Yeah. So these three main types of dilutive securities, which basically have the term of being converted into ordinary shares of equity at a specified time, yeah, later on. That's why they will dilute or they will reduce the earning per share of the company. Earning per share mostly is calculated based on number of ordinary shares. Yeah? So when the number of ordinary shares increase because of the conversion features of this share options, convertible debts, and preference shares, so the value of earning per share will also reduce, yeah, because the number of ordinary shares becoming more or increasing. Okay, let's look at the convertible debt first. Yeah? So convertible debt, as I mentioned briefly just now, are the debts that later on can be converted into ordinary shares, yeah, or equity. Yeah. Why the company wants to issue convertible debt like convertible bonds? Yeah? Because there are advantages both for the company as well as for the bondholder, yeah, or the people who buy the bonds, yeah, because it guaranteed the interest and the principal payment to the bondholders. Yeah. And also, it has the benefit of converting it for shares later on, yeah, if the holder of the bonds are willing to convert. Yeah. For the companies, why they issue the convertible bonds, yeah, there are certain benefits of issuing convertible bonds, yeah, because they can raise the capital of the company without giving up more ownership control than necessary. Yeah? Meaning, if they issue the additional ordinary shares, there will be more equity ownership by other parties. Yeah? But if they issue the bond, it will not increase the ownership of the equity, yeah? The ownership of the company. Yeah? But the company has the benefit of getting the additional capital. But the ownership structure, which means the equity ownership, yeah, is still the same. Yeah? It doesn't affect the ownership structure. Yeah? Because remember, the bond, it goes to the liabilities, not the equity. When we mention ownership, it refers to the equity or the shareholders. Yeah? Second reason is normally issuing the convertible bond will allow the company to get the debt financing at a cheaper rates. Why cheaper rates? Because it has the feature of conversion into ordinary shares. So that feature or term or privilege will make the bond issuance that can be done at a cheaper rate compared to the usual bond issuance. Yeah? The normal bond without the conversion feature will have a higher or more expensive to be issued. Yeah? But the convertible bond has slightly a cheaper rate because it has that benefit attached with the issuance of such bond. Okay. So that's why we call convertible debt as a compound instrument. Yeah? Compound instrument means it has both the liability as well as the equity features. Yeah? So for the compound instrument, the companies has to use the with and without method to value the compound instruments. Yeah? What does it mean by with and without method? Means with what is the amount if it is with the liability, what is the amount of equity without the liability component. Yeah. So when a company issue a convertible debt, they would calculate the value of convertible debt at the date of issuance with both debt and equity components. Yeah. And then they would deduct with the fair value of liability. So we get the value of equity without the debt component. Yeah, because you see, remember that dilutive securities, specifically convertible debt, has the element of both liability and equity. So we have to separate it. Yeah, what is the value with the liability? What is the value without the liability component or debt component? Yeah. So how do we do the with and without approach? First, we calculate the total fair value of convertible debt with both the liability and equity component. And then we calculate the liability component of the convertible debt by having the net present value of all contractual future cash flows discounted at the market rate of interest. So the liability mostly refer to the future interest payments, but discounted into the current fair value. And then we deduct or subtract the liability component or the debt component just now from the second part from the total fair value of convertible debt with both the liability and equity component. Yeah? So for example, this Roche Groups issues 2,000 convertible bonds at the beginning of 2019. The bonds have a 4-year term with a stated rate of interest of 6% and are issued at par with a face value of 1,000 euro per bond. The total proceeds received from issuance of bond are 2 million. Yeah, so basically 2,000 times 1,000 euro. 2,000 units times the price per unit is 1,000, so you get 2 million. Yeah? Interest is payable annually at December 31st, and each bond is convertible into 220 ordinary shares with a par value of 1 euro. Yeah? The market rate of interest on a similar non-convertible debt. Yeah. So we want to know what is the interest rate for the non-convertible debt. Yeah, a similar one in the market is 9%. Yeah. So first, we calculate the present value of the principal amount, which is 2 million. Yeah? 2 million, the proceeds from the bond issuance. Yeah, so we get the present value of 1,416,860. And then we calculate the present value of the interest payment. Yeah? So we base on the interest rate of the similar non-convertible debt, yeah, which is 9%. Yeah? So we get the present value of the debt component is 388,766. Yeah. So the total of present value of principal plus present value of the interest payment give us the total present value of liability component. Yeah? So then we do the with and without method. We take the fair value of convertible debt at the date of issuance. This fair value of convertible debt means it has both the debt and equity, yeah? The 2 million. And then we minus the fair value of liability component at the date of issuance, which is 1,080,000, blah, blah, blah. Yeah? So then we get the fair value of equity component at the date of issuance. Okay. So we would record at the date of issuance. Issuance of bond means we receive the cash in the amount of 2 million. Yeah? And then we'll credit the bonds payable at the present value of the liability component. Yeah. So for the bond, if you still remember, I think we have discussed in the previous intermediate accounting one, there is an amortization schedule for the bonds payable. Yeah? So on the date of issuance means here there is a discount on this bond. That's why you get the bonds payable of 1805606. Yeah. And later on until the maturity, from the amortization table, at the end of maturity, we will have the total of 2 million bonds payable. Yeah? And then the equity amount just now, we will record to share premium conversion equity. Yeah? Okay, after the issuance of convertible bond, what happened if that bond is repurchased at maturity? Yeah? Means the bonds are not converted into ordinary shares. Yeah? The company is paying back that bond. Yeah? So Roche, the company, will make the following entry to pay off all the convertible debt holders. Yeah, remember this is a debt. So on the date of maturity, you will pay back the debt to the bond holders. Yeah. So debit the bonds payable 2 million. Remember just now, even though when the date of issuance, we credit the bonds payable at the amount of 1,805,606. But as the time goes until maturity, because there is amortization table, just we'll add the interest, yeah, until the date of maturity, we'll pay the full face value of 2 million, yeah, and we credit cash 2 million. Yeah. What happens to the share premium convertible debt conversion equity of 194,394? That one can stay in that account, which is share premium conversion equity, or it can be transferred into the share premium ordinary account. Yeah. Okay, that's the first scenario. Yeah, what happened if it was repurchased on the date of maturity, repurchased by the company, yeah, or paid back, yeah, to the bondholders. Yeah. What if it is converted at the date of maturity? Yeah? So the company will make the following entry. We would debit share premium conversion equity. Basically, we close that account because we want to transfer to the share premium ordinary account. And then debit bonds payable 2 million. We credit share capital ordinary 500,000. How do we get 500,000? Remember, for each where is it? For each bond is convertible into 250 ordinary shares, yeah, and the company issued 2,000. So 2,000 divided by 250. So you get 500 shares, yeah, when they convert it, and 200 and 500 number of shares we times it the par value of ordinary shares, which is €1 just now. Okay, so that's how we get um, 500,000 share capital ordinary. Okay. Sorry, you don't divide 2,000 with 250 because one bond you get 250, so you times it, yeah? So you multiply. So 2,000 multiply with 250. That's how you get 500,000. Sorry, I made mistake just now. And you times with the par value of €1. Yeah? And all the extra goes to share premium ordinary account. Okay. So basically, whatever was recorded in the share premium conversion equity has been transferred to the share premium ordinary account. So that's how accounting treatment for the convertible debt or bond if it is converted at the maturity date. Yeah. Okay, what happens if the conversion of bonds before maturity? Yeah. Remember I mentioned to you about the bond amortization schedule. So this is the table of amortization schedule, yeah, to record the carrying amount of bonds, yeah. And the discount is amortized over the period, yeah. So until the end of maturity, you'll get the full face value of the bond, yeah. Okay, conversion of bonds before maturity, assuming the same example that Roche Company converts its bond into ordinary shares on December 31st, 2020. Okay, December 31st, 2020 means at the third year, yeah? And the maturity is at the end of fifth year, yeah? So what happens if it is converted earlier than the maturity? We will still close the share premium conversion equity account and then bonds payable. Bonds payable will take the carrying value on this date. Yeah. Curve back the table. The carrying amount of bond on that date is 1,894,464. Yeah? And still will credit the share capital ordinary 500,000. Yeah. And the excess will go to the share premium ordinary. Yeah. It doesn't involve any cash because this is just a transfer or a change from the debt into equity. Yeah? We don't issue, it's not a new issuance of ordinary shares, yeah? But it is converted from the bond into ordinary shares. So there is no additional cash is received in this kind of transaction. Yeah? Okay, let's say a repurchase before maturity. Okay, so we had covered three scenarios just now. First is repurchase on the maturity. Yeah, means there is no any conversion, and then conversion on maturity, and then conversion before the maturity. And now, what if it is repurchase or paid back before the maturity? Yeah. So let's say the ROCE determines fair value of the liability component of convertible bonds at December 31st, 2020, and then subtracts the fair value of convertible bonds issue, including the equity amount, to arrive at the value of equity. Yeah? And then the difference between the consideration allocated to the liability component and carrying amount of liability is recognized as a gain or loss. Yeah? And the amount of consideration relating to the equity component is recognized as a reduction in equity. Yeah? Okay, let's say if the fair value of convertible debt, including both liability and equity components based on market prices at December 31st, 2020 is 1,965,000. The fair value of liability component is 1,904,900. Yeah, it's based on the present value of non-convertible bond with a 2-year terms. Yeah, because we repurchased before the 5-year maturity. Yeah. Okay, so we deduct the present value of liability minus the carrying value of liability. Then we identify the loss on repurchase. Yeah. So we take the fair, any adjustment to the equity. Fair value of convertible debt with equity component is 1,965, which is the fair value just now given. Yeah. And then the less fair value of liability component at December 31st, 2020. Yeah, so we get the fair value of equity component at December 31st, 2020 of 60,100. Yeah. So how do we record? We'll close off the bonds payable at the date of 31st December 2020. Yeah, the carrying amount. And then close the share premium conversion equity. And we identify the loss on repurchase and we credit the cash. Yeah? Based on the fair value that we have to pay back to the bond holders. Yeah, I know it's a bit complicated. You try to do it, the exercise later on, read again, then you can understand. Yeah. Okay, now we discuss about the issue of induced conversion. Yeah, induce means stimulate. Yeah, I think you understand. Like in the labor, delivery, yeah, pregnancy, delivery, there is an induction, induce. Yeah, means they stimulate. Yeah, for a woman to give birth. So it's almost similar understanding to the induced conversion. Yeah. The company or the issuer they want to encourage immediate conversion. Yeah, they want to push the bondholders to convert immediately. Yeah, not waiting for the maturity. Yeah. So the company or the issuer will offer additional bonus, yeah, or call a sweetener, yeah, to motivate them to convert, or to induce the conversion. Okay, so that kind of sweetener or bonus given or incentive given for the bondholders to immediately convert their bond into ordinary shares will be recognized as the expense of the current period. Okay, for example, the company has outstanding 1 million par value convertible debentures. Debentures is another word for bond or another term. Convertible into 100,000 ordinary shares, $1 par value. When issued, the company recorded share premium conversion equity of 15,000. Yeah. And the company want to reduce its annual interest cost. When they say they want to reduce annual interest costs, so they want to motivate the bondholders to immediately convert their debt into ordinary shares. Yeah. So to do so, the company agrees to pay the holders of its convertible bond an additional 80,000 if they will convert. Yeah. So the company would give 80,000 incentive for the bondholders to be willing to convert their bond into ordinary shares. Yeah. So let's say the bondholders are willing to convert, the company will have to make the following entry. Yeah? So that sweetener or that incentive is regarded as a conversion expense. Yeah? So we record conversion expense debit 80,000. Debit share premium conversion equity. Yeah, we close off that share premium conversion equity and we credit share capital. Oh yeah, bond payable, sorry. Forgot about the bonds payable, 1 million, and then we credit share capital ordinary, 100,000, and share premium ordinary, 915,000, which is the excess. Yeah, how do we get share capital ordinary 100,000? Because they say outstanding 1 million convertible into 100,000. Yeah, it's already mentioned the total number of ordinary shares to be converted. And we multiply with the par value. Okay, convertible preference shares. Yeah, just now convertible debt. Yeah. Okay, some types of preference shares has the option for the shareholders to convert their preference shares into certain number of ordinary shares. Yeah. So convertible preference shares are reported as part of equity. Yeah, even though it has the debt element, yeah, the preference shares, but it is reported as equity still because it is shares. Yeah. Okay, when preference shares are converted or repurchased, we don't recognize any gain or loss. Yeah, let's see. For example, the company issues 1,000 convertible preference shares that have a par value of €1 per share. The shares were issued at a price of €200 per share. So you record the issuance first. Cash 1,000 times 200. The price per unit, we get 200,000. And then preference shares, share capital, we record as 1,000 because the par value is 1. And then share premium preference. Okay, oh yeah, we have to calculate the share premium conversion equity calculated based on present value. Oh, sorry, because this is convertible preference shares, Then we straightly record the excess amount to share premium conversion equity. Yeah? We don't record share premium preference shares. Yeah? If it is a normal preference shares issuance, not the convertible one, then we'll record straightly into share premium preference shares. Yeah? Okay, let's say each preference shares just now is subsequently converted into 25 each ordinary shares that have a fair value of 410,000 euro. So the journal entry to record the conversion is we will debit the share capital preference, just now 1,000. And then we will debit the share premium conversion equity. We close that account and we will record the share capital ordinary, because it's converted into ordinary. So 1,000 times 25 each ordinary shares, and we multiply with the par value. And we will credit the share premium ordinary 150,000, which is the excess amount. Okay, if the convertible preference shares are repurchased at their fair value instead of converted, means the preference shareholders are not converting their shares, means the company are repurchasing back those shares, So how the company will do the entry? It would debit the share capital preference, close also the account of share premium conversion equity, and will credit, we debit the retained earnings of 210,000 and we credit cash of 410,000. So just now, the fair value is used to record the repurchase, and the fair value was 410,000. That's why we have to pay back of 410,000. So the balance, the insufficient balance from the share capital and share premium will be taken from the retained earnings. The same like when the company pays the dividend, it has to take from the retained earnings. Because retained earning is part of the equity component. Okay, I'll stop at that first, and I'll explain the next topic on the share warrants as well as calculation of EPS in another video. So thank you. Assalamualaikum warahmatullahi wabarakatuh.